The Australian dollar was quite range-bound early in the week, but then sparked to life on Wednesday when Australia's Q4 GDP report came in much stronger than expected. GDP grew by 0.6% in the quarter and 3% over the year. That's only the second time since 2012 that growth has hit 3%. In the details, it was encouraging to see a sharp rise in household consumption. Consumers spent strongly in the third and fourth quarters last year, which provided very helpful offset to the ongoing weakness in Western Australia and Queensland, driven by the fall in mining investment. The question remains, though, how long this will be sustained. Wages growth, as we've discussed before, is very weak. This means that consumers were dipping into their pockets more deeply in the second half of last year, with the household savings rate falling to its lowest level since the global financial crisis. Despite such reservations, FX markets took the Australian GDP numbers very positively. The Aussie dollar broke through the 73-cent mark for the first time since January. In the background, on the commodity side, there has been some cause for ongoing support as well. Iron ore prices have become a bit more mixed, but they're still above $50 a tonne. And the gold price has soared to its highest levels in 1 year. Overall, our index of Australia's export commodity prices is at a high since October. Yet we wonder how much further the Australian dollar can rally so long as markets continue to ponder the risk of another RBA rate cut. On Tuesday, the RBA repeated that it had scope to lower rates if needed to support the economy, given that inflation was under control. And even after the GDP numbers, markets are still pricing in a 40% chance of a rate cut by May, rising to 100% by October. This is likely to keep a lid on the Aussie multi-week. In the week ahead, we're going to see Australia's consumer sentiment and business confidence surveys. We'll also hear from the Reserve Bank of New Zealand, which is reviewing monetary policy on Thursday, with some risk of a surprise rate cut there. But most eyes will be on the ECB on Thursday. Markets were disappointed in the steps the ECB took to loosen monetary policy in December, and the euro actually rose afterwards. But we expect that this time the euro will fall, with aggressive monetary easing likely to be announced, including a further cut in the deposit rate from negative 0.3% to at least minus 0.4%, and most importantly, an increase in the monthly total of quantitative easing or money printing, which is currently running at 60 billion euros per month. This should be enough to undermine the euro and may well see some funds flow towards the Australian dollar where yields are higher. This should leave the Australian dollar trading fairly comfortably, mostly in, say, a 72 to 74 cent range over the next week or so. Targets such as 75 we think will prove difficult at this point, so long as markets continue to price in a considerable risk of the Reserve Bank of Australia cutting interest rates again. We'll speak to you next week.